Good morning on this freezing cold winter's morning. I hope that you're all well and that your brains have woken up, because this morning we're going to be talking about how we can manage gross profit in your business. Before we get started, always just a couple of tips to continually prevent COVID-19. Please wear your masks when you're out in public, cover your nose and mouth, wash your hands with soap or alcohol-based sanitizer. Don't touch your eyes, nose, or mouth with unwashed hands. It's amazing how often we tend to want to touch our face. Avoid close contact with people who are sick, and cover your cough or sneeze with your elbow, or do it into a tissue and throw that in the bin or down the loo. And then clean and disinfect frequently used surfaces and objects. Obviously, we're still fighting this third wave, so it's very important just to keep those things in mind before we continue. So what we're going to do today is I will start with doing an income statement overview, just to put gross profit into context with regard to the income statement. Then we will talk about what gross profit actually is. We'll do a short exercise where you get to calculate what GP margin is. So please make sure that you do have a calculator, or you can use the one on your phone if possible. And then we'll talk about why it's important to monitor your gross profit in your business. And as we're going, if you have any questions, I'd be happy to take them. So let's start off with the income statement, the basic income statement layout. And so on the screen, you'll see what a basic income statement looks like. Sometimes this is called a profit and loss statement. It's exactly the same thing. And basically, what an income statement is it's a recording of the transactions in your business. And normally we do it on a monthly basis. And so if you look at the first line, you'll see that it says sales turnover. This is often also known as revenue, as income, or just sales, or just turnover. So it's very important that you record all your transactions, that you get an accurate sales figure for your business. Then on the next line, we have what we call cost of sales, and we take sales turnover and we minus cost of sales, which will give us gross profit. Then we minus our ops expenses, and this is things like transport, petrol, rentals, salaries, anything like that goes into this amount. And at the end of that, when we minus that from our gross profit, we end up with operating profits. And so we've just used some random numbers here. So if your sales was 85,000, you minus your cost of sales to give you your gross profits, and then you minus your ops expenses to get your operating profits. And we always like to use the analogy of a water filter. And this is a nice, easy way for you to remember the flow of the income statement, because you start off at the top with your sales. If you've seen a water filter, it goes through all sorts of filtering. There's coarse sand, there's charcoal, there's fine sand, and what you end up with at the bottom is pure water or filtered water, and that's basically what your profit is. So if you pour the sales in the top and you take off your cost of sales, and then obviously you have your expenses down here, you'll end up with the water, purified water at the bottom, or the equivalent of your profits. So that's what a basic income statement looks like, or profit and loss statements. So when you see any organization, when they publish their financials, or hopefully in your businesses, this is what the layout of the income statement should look like according to the general practice of accounting principles. And so what is gross profits? I've been through the whole income statement, but gross profit is basically the profit that you make after you've minused your cost of sales from your sales turnover. So a lot of people, because there's so many different ways of referring to profits, people often get confused, and they will say, they'll refer to GP as something else. We also call it GP for short. And so this is gross profit. When you get to the bottom down here, that's when we deal with net profits. And that's very important to distinguish, because GP, there should be industry benchmarks for gross profits, depending on what business that you're in. And so it's simply your sales turnover, or your income, or your revenue, minus your cost of sales. And we're going to talk about these two elements because these are the two elements that impact your gross profits a little bit later on. But for now, we're going to talk about what gross profit margin is. And so you'll often hear people referring to GP margin, and margin is simply a percentage. So when everyone talks about margins or GP margins, they're generally referring to your gross profit margin, which is a percentage. And when we're dealing with our income statement, what we try and do, well, not what we try and do, what we do is that we take everything as a percentage of turnover. And so if you look at if I go back to this income statement that I used earlier, I've just taken this top section over here, and we're going to calculate what your gross profit margin is. So if we take gross profit times 100 to get the percentage and divide it by sales turnover, that will get your GP margin. So if you could try and do this calculation for me and see what you get as your GP margin, which would be your GP percentage. So you're taking your GP margin, you're dividing it by your sales turnover, and then you multiply it by 100. So if you could just type that in the chat box, or I don't know if we can put the marks on so that you can give your answers to what you get for that calculation.
Okay, perfect. I'll read out any questions that come through from the Q&A or chat tab.
Okay.
Okay, we've got one that came through, 52%.
52%, yeah. Anyone else?
Another 52%. Yeah, we've got 52%, no?
Okay, that's correct. So 52. Okay. So the reason that we want to calculate our gross profit margin is that it's a very nice way to monitor how we faring with our GP as we go along, because these figures will change over time. It's very difficult if you're suddenly making 120,000 in turnover, and your cost of sales changes, the percentage will work out differently. And so I really would encourage you, when you're talking about your GPs, to look at what your GP margin is so that you can compare it month to month, because your income statement should be done every month. And if you're comparing it month to month, then you have a way to monitor whether, where something's going wrong. And because this is kind of your first line of profits in your income statement, it's the most important one to monitor, because if something's going wrong with either of these two things, then it's time for you to investigate what's happening in your business. So this is called your GP percentage or your GP margin, when you take your gross profit and divide it into your sales turnover. And what that's basically saying is, what percentage of my turnover am I making in gross profit? Okay, now we're going to talk about how to calculate gross profit margins in a little bit more detail. So here are another two examples that I want you to do. So in this case, this is month 1 and this is month 2. Your turnover in this month is 100,000. Your cost of sales is 60,000, and then your gross profit is 40,000. So that's what's left after you've taken your cost of sales. In month 2, your turnover is 160,000. Your cost of sales is 105,000, and your gross profit is 55,000. So using this calculation for each month, can you calculate for me what your GP percentage would be for each of those months?
Yeah, I've got nothing coming through yet. I encourage everyone to please take part in the calculations. All right, so we do have 40% and 34.3%.
Yes, very good. Anyone else? Kurt, who has raised his hand, I see. Kurt, did you want to ask a question? No.
All right, we've got another 2 answers, 40% and 31%, and then we've got 40% and 34%.
Okay, Okay, the correct answer is 34.37. So if you can just recalculate that again, and how you do it, as I said, is by taking the gross profit and dividing it by 160,000, which is your turnover, times 100 to get a percentage. If you have a percentage key on your calculator, you can just say 55 divided by 160 and press the percentage, and it should give you the same answer. I see that it's the same people that are answering every time. I just want to open the floor for any questions or clarity. I'm happy to go over it again if need be, because it's really important that you get this calculation. If you're confused, please feel free to ask me a question, because if you don't understand this, then the next section, it kind of builds on this. So is there anyone that needs any clarity? So the answers are 40% and 34.37. So well done to those of you who got that. So the next thing we're going to talk about is the importance of monitoring GP in your business. And as I said earlier on, gross profit is a function of two things. It's a function of sales, and it's a function of cost of sales. Because remember, when we did this calculation, we've said sales turnover minus cost of sales is what gives you your gross profit. And so when we think about GP, there are only two things that can affect it. It's either your sales or it's your cost of sales. So if your GP goes out of sync or out of whack for some reason, these are the two places that you need to look to see what's going on. So when it comes to sales, remember that sales is a virtue of the number of transactions in your business and your average transaction value. So these are very small numbers just to help you understand. So if you've got 50 transactions and each transaction is worth 30 Rand, that means that your sales turnover will be 1,500, because you multiply your number of transactions by your average transaction value. And so if you increase your number of transactions and leave your transaction value the same, it will make your sales go up to 1,710. If you leave your number of transactions at 50, as in the first example, and multiply it by your transaction value of 38, it means that your sales go up to 1,900. And then if you increase both, it goes up to 2,166. So when you're doing any kind of marketing or anything to improve the sales in your business, it will either be to increase your number of transactions, or it will be to increase your average transaction value. So how much is each of these people spending in your business? That's what the average transaction value is. So when you are asked what is impacting on your sales, it's one of these two things. And in a minute, we'll talk about how you can impact that. And then cost of sales, you always calculate as opening stock plus purchases minus closing stock. That will give you your cost of sales. It's not just your purchases for the month, because if you buy something and it's still left over in your closing stock, it means you haven't used it to generate your sales in that month. And so cost of sales is what is it costing me in this month to generate the sales that I've made. And it's very important for you to understand this calculation. So whatever I've got in stock plus whatever I've bought minus my closing stock, that's what my cost of sales is for this month. And so, as we said, with sales, if we look at the number of transactions or average transaction value, we have to ask the question, what can we do to increase either one of these two elements of sales? And I would normally ask you to give me some idea, but due to the time, I just want to get through some ideas that you can write down or watch the recording again. So in order to increase the number of transactions, there are a couple of ways we can do that. One is by improving the visibility of your business. And that could be through signage, it could be through branding on your trucks or anything like that. You could do promotions where, if you know that people's geysers generally break a lot in winter, you can do a promotion where you tell people that you'll give a discount for that. Any promotional material like flyers or anything. Stock availability, obviously, if someone comes to you and you don't have the stock that you need available, That will impact on your number of transactions. The quality of your service or product, this is the most important thing to me, is that you have to have good quality of service and products in order for you to get word of mouth referrals, which will increase your transactions, which it says, yeah, referrals and word of mouth. Obviously, pricing is important. And if you're in a retail kind of environment, then cashiers would be important. The people that are actually selling your goods and services. And then your average transaction value, you can increase through cross-selling. And cross-selling means what is something that goes with something. So if you sell a geyser, maybe you've also got a geyser cover or a blanket that you put over the geyser or something like that. So something that goes with something. Selling up is basically what it says, is selling something bigger than what the person wanted to buy, or a higher quality that costs more. If your product knowledge is good, you can improve your average transaction value because you can tell the customers about your products. And then if you've got any value added products, services and deals and combos, and then again, good service. So when you're in a position that you are struggling with sales, please look back at this. And these are the things that you can do to try and improve your sales, and do it consciously, like plan to do it in your business to improve your sales. And then in terms of cost of sales, the most important thing is your stock control. And so if you are not doing all of these things, then you will find that your stock, your cost of sales gets out of hand. You need to make sure that you place orders correctly and that you don't over order stuff, because money, if you've got stuff sitting in your storeroom or sitting in your cars, then it means that your money's there. It's not where it needs to be. Receiving stock is important. Make sure you get what you ordered. If people deliver to you, double check for invoice discrepancies, especially if you're placing big orders. It's very important to make sure that that's accurate. Make sure your stock is stored properly, that you rotate it and do stock checks, and also make sure that you process all transactions, because without processing your transactions, you'll find that stuff goes missing mysteriously and you don't know how to account for it. Okay, I think I'm going to end there because the time is at 7:20, so I don't want to go over the time. The other stuff that I just wanted to mention quickly is the reasons why your margin can drop. And the main reason is if you discount. So if you discount, it means your sales turnover goes down, but your cost of sales stays the same. Also, if your input costs increase and you don't adjust your price. And then if you don't apportion your materials properly, so that means if you use X amount of tape or filler or screws, you must make sure that you do it per job. And then if there's any shrinkage, people steal, there's any waste or breakages or admin errors, that will cause your margin to drop, because these things all affect turnover and cost of sales. And then lastly, how we increase it is to avoid overstocking. Make sure that you apportion your stock correctly to each job and your sales mix. So depending on what you're selling, that will affect your GP margin. So you can, by selling more expensive stuff with better GP, you can increase your margin. And that's me.